If you own an S&P 500 index fund, you probably think you're holding 500 companies. You're not. Right now, 10 of them control roughly a third of everything that fund owns. That's a higher concentration than the dot-com bubble ever reached. And the last 2 times the market got this top-heavy, it didn't end quietly. By the end of this video, I'll show you exactly what happened both times and what it means for the diversified fund sitting in your retirement account right now. Apple, Microsoft, Nvidia, Alphabet, Amazon, Meta, Broadcom, Berkshire Hathaway, plus a rotating cast of other megacap names. As of recent years, that's roughly the top 10 holdings inside the S&P 500, and together they've made up somewhere between 35 and 39% of the entire index's value. Nvidia alone crossed a multi-trillion-dollar valuation, and on the days it reports earnings, its stock price can single-handedly drag the whole index up or down. Here's the picture that matters. 10 companies now hold more than a third of the S&P 500's total weight, and that gap with the other 490 combined has been closing for years, even though it hasn't closed yet. The fund is still called 500 companies, but 500 companies and diversified exposure have quietly become 2 very different claims, and most people holding this fund have no idea the gap has opened up this wide. None of this makes these bad companies, quite the opposite. They're some of the most profitable businesses in history, but that's exactly why it's easy to miss the risk. When you buy an S&P 500 fund because you want broad, spread-out exposure to the American economy, you're actually making an outsized bet on a handful of technology giants riding the same wave, whether you realize it or not. So how did 10 stocks end up with a third of the index? It comes down to one word: weighting. The S&P 500 isn't 500 equal slices of pie. It's weighted by market capitalization, a company's share price multiplied by its shares outstanding. The bigger a company gets, the bigger its slice of the index becomes automatically. No committee votes on it. No one rebalances it back down. The math just does it on its own, every single day. Now follow the loop. A stock's price goes up, so its market cap grows, so its weight in the index grows. Every dollar that flows into an S&P 500 index fund gets automatically split in that same proportion, meaning the biggest stocks get the biggest chunk of every new dollar invested. That extra buying pushes the price up further, which grows the market cap again, which grows the weight again. It's not a conspiracy, it's arithmetic. But it means passive investing today isn't quite as neutral as it sounds. This loop matters more than it used to because of the sheer scale of money running on autopilot. An estimated tens of trillions of dollars now sit in U.S. index and passive funds. Every paycheck that gets automatically invested into a workplace retirement plan, every dollar that flows into a target date fund, follows this exact same cap-weighted formula, mechanically buying more of whatever is already the biggest. The winners don't just win, they get structurally reinforced. This isn't the first time Wall Street fell in love with a small group of must-own stocks. Rewind to the early 1970s, and you'll find a group of blue-chip stocks nicknamed the Nifty 50. Names like Coca-Cola, IBM, Polaroid, and Xerox were considered one-decision stocks. You bought them once and never sold, because how could a company that great ever go down? Investors piled in at almost any price. And the prices got extreme. By 1972, some of these safe blue chips were trading at 50, 60, even 90 times their annual earnings, multiples usually reserved for speculative startups, not household names. Nobody worried about the price because the story was simple. These companies were too good to ever sell. Then came 1973 and 74. The S&P 500 fell nearly in half over that stretch, one of the worst bear markets of the 20th century, and the Nifty 50 didn't hold up better than the rest of the market. Many of them fell 80% or more from their peaks, wiping out over a decade of gains in less than 2 years. Here's the part worth sitting with, though. These weren't bad companies. Coca-Cola and IBM survived, adapted, and went on to thrive for decades. The lesson isn't that the Nifty 50 were frauds or empty hype. It's that even great companies can be terrible investments when you buy them at the wrong price and hold too much of them at the wrong weight. Fast forward to March of the year 2000 and you get the second time this happened. At the peak of the dot-com bubble, the top 10 stocks in the S&P 500, names like Microsoft, General Electric, Cisco, Walmart, ExxonMobil, and Intel, made up roughly a quarter of the entire index. For a brief moment, the technology sector alone touched around a third of the index's total weight. Even at that historic extreme, estimates put the top 10 at only around 25 to 27% of the index. Today's top 10 sit at around 37%. That means the concentration we're looking at right now has already moved well past the dot-com peak. This isn't a history might repeat video. It's a we're already past the last extreme video, and that's worth sitting with for a second. What followed the dot-com peak wasn't gentle. From March of 2000 to October of 2002, the Nasdaq lost roughly 78% of its value. The broader S&P 500, dragged down by its own top-heavy names, fell around 49% over that same stretch. 2.5 years of gains erased in a single downturn. But here's the part nobody really talks about. Concentration isn't just about counting 10 tickers, it's about counting themes. Look closely at today's top 10 and most of them aren't just big. They're the same bet, wearing different labels. Technology, communication services, consumer discretionary on paper, 3 different sectors. In practice, many of them move together because they're riding overlapping parts of the same story. Officially, the S&P 500 sorts these companies into different boxes. Unofficially, much of the top 10 now rises and falls on a shared headline. How much money big tech is spending on AI infrastructure, and whether that spending is paying off. Different sector labels, overlapping underlying bet. Compare that to the year 2000. Back then, the top 10 were genuinely spread across different corners of the economy, energy, industrials, retail, and technology, each with its own separate reason to succeed or fail. Today, real diversification isn't just about counting how many company logos sit in your fund. It's about asking whether those companies would actually stumble for different reasons or overlapping ones at the same time. So let's finally answer the question from the start of this video. Both times the market hit a concentration peak like this, the Nifty 50 in the early 70s, the dot-com leaders in 2000, what actually happened to the fund sitting in an ordinary investor's account afterward? The answer isn't dramatic. It's slower and honestly more interesting than a crash headline. After the dot-com peak, the S&P 500's equal weight version, where all 500 stocks get roughly the same slice, instead of letting the biggest dominate, outperformed the concentrated, cap-weighted index for most of the following decade. Something similar happened after the Nifty 50 crash. The boring, overlooked stocks outside the favored 50 recovered faster than the darlings everyone had piled into. Now the honest caveat: concentration peaks are a risk signal, not a timing signal. They tell you nothing about exactly when a correction happens. Expensive leaders can stay expensive for years before anything shifts. This could easily be a 5-year story, not a 5-month one. Anyone telling you they know the exact top is guessing, and you should treat that guess accordingly. Here's the bigger shift, though. Owning an S&P 500 fund today hands you meaningfully more single-theme risk than the exact same fund gave you back in 2010. The rules of the index haven't changed at all. Market cap weighting works exactly like it always has. What changed is the market underneath those rules, and it changed quietly enough that most fund holders never noticed. So here's the actionable part, for educational purposes, not a personal recommendation. Before you assume your index fund is spreading your risk around, open its fact sheet and look at the top 10 holdings percentage. Then compare it to where that number sat 10 years ago. That 10-minute check tells you more about your real diversification than the fund's name ever will. If this changed how you think about money, subscribe. There's a new breakdown every week.